15 grand exposure to metals, long metals, short metals, leaning against each other. So when you think about those, you might say $90 commission's an awful lot of money. Yeah, it is a lot of money, of course it is. For an exposure of just $125,000 worth of metal, which is one single contract. But $910 profit in 60 odd seconds, trading that exposure, I think, is an incredible way to trade. Maybe I'm wrong, but I think there's a very, very nice value to this type of stuff, this type of information, guys. I think there's a very nice way of looking at the overall shape of the marketplace here. I've sold some bonds off the 19s, 20s. It's currently trading 17s, 18s. I'm going to be trying to take a bit of money off this 16s here. I am getting some filled at 16 actually, so that's quite nice. So currently short bonds, and starting to drop off quite nicely now, guys. Now, one of the things that we may be doing in the max program, if there is a genuine interest in spreads, is that we may well do a max spread algorithm as well, so that we can actually do the spreads. But obviously that's going to be very much dependent upon people's account sizes. It's going to be the biggest driver of anybody wanting to do the spreads, is that you would obviously need to be in a relatively large account if you don't have offset margin with your broker, of course. If we start putting together a large gold silver position, then of course you need to have that offset margin, otherwise you could end up paying out huge margins on it. We said we'd maybe touch on a couple of spreads today. We were going to be looking at any opportunity to maybe get we were going to maybe look at an opportunity to get some Nasdaq YM spreads into your thoughts. And unfortunately, when I mentioned that the last time, I'd been watching to see if we were going to get one whilst we were talking about it. Unfortunately, we didn't get one, and we just unfortunately never managed to get one in front of you. So hopefully one will set up this afternoon and we can start showing you guys, and we can maybe pop it into the depth of market so you can see how the trade eventually evolves. And that's what we're going to be watching for. We're going to see if we can get one. Remember I said about the bottom edge S&P becoming a buy trade, and we can maybe try and capture the spread during that buy phase. Well, it's gone by. It's obviously gone bid after running the stops of the RGL. But again, still unfortunately, we still don't have the setup. We did have one at 12:30, exactly at 12:30 for a spread, but it is a spread trade, so it's nothing much I can show you about it. But there was one at 12:30. Anyway, welcome in, guys. Sorry, I'm babbling on about spreads because I was talking to the guys about spreads this morning. We were looking at depth of market, lining up some of the depth of market, and as I said, we were just mucking about with it this morning with the guys to show them how easy it was to pick up some narrative with regard to the likes of oil against RBOB, with regard to gold against silver, with regard to the YM against the Nasdaq, with regard to anything against anything else, and just setting up a static depth of market and then looking at the movement inside that static depth of market, telling you that a spread was setting up, and being able to maybe take a chance of a trade against it. Now, if you just trade it as that, you're going to get some interesting trades, but it doesn't mean you're going to be successful. Just because it's diverging in the depth of market, it can diverge in the depth of market all day for days on end. The divergence can develop. The point is you've got to know what you're looking for in terms of spreads. Otherwise, it's a kind of pointless exercise, really, isn't it? So that's something that we have to, make sure we do just pay attention to. Is it's not simply just a case of doing that. Now, when you're doing depth of market type trading, the idea is to get set up on a demo account so that you can start looking at these things and start thinking about what it is you're trying to do. Now, it takes practice. When you're getting a demo account and it takes practice, what you're wanting to try and do is just center the price, okay? So when you center the price, what you're looking for is you're trying to find something inside these two prices. Now, obviously, you can watch it visually, And one of the ones that, so you can see that you can see the Nasdaq's a way up, and you can see the YM's a way down. So you can say, right, I'm going to sell Nasdaq and I'm going to buy YM, sell Nasdaq, buy YM, sell Nasdaq, buy YM. You could be doing that for a long, long time and not making any money. So one of the things you've got to try and do is make sure that you don't, that's not what you're doing, because obviously you could just keep resetting this, and all of the while, the Nasdaq could lead the YM for days. You know, so if that's all you're doing, you're never going to be successful as a spread trader, guys. That's madness. What you've got to try and do is try and understand the relationship. You know, if you just take a ZB and a UB contract, and every time the UB upticks against the ZB contract, you sell the UB and you buy the ZB, you're a terrible, terrible, terrible trader. Because that's not explaining why it's happening. If the UB is extending up against the ZB contract, then obviously that's a very, very back end, well, depending upon what's happening, it's either a very, very big back end flattener or a back end steepener. We know that those flatteners and steepeners can last for days and weeks. So it's a horrible, horrible thing to just do because it's going out of line. Horrible. I mean, it'll work sometimes, but you're going to get the macro trade massively wrong. It's like one of those horrible algorithms that came out on MT4 that bought and bought and bought, and eventually they just kept all the losing trades open, and they closed off these crappy small winners. Well, eventually you're going to get your account handed to you when you do that type of nonsense. So there's a lot of people who do a lot of these types of things without really understanding why they're taking the difference between the two. And you've got to understand why you're taking the difference between these markets. It's not about seeing this setting up, for example, here on the YM and saying, right, YM's dead expensive. I'm going to try and sell that YM up here, and I'm going to put a bid into the Nasdaq. Okay, we're filled in the Nasdaq, right, let's get one YM. There you go. So there's the trade, but this could lead that market forever. This could lead that market forever. So unless you know why you just bought a Nasdaq against a YM position away up here, it's stupid. It's a stupid, stupid trade, isn't it? You could say, well, it's widening. It's widening. I'm going to take another buy on the I'm going to take another buy on the Nasdaq, and I'm going to try and get another sell in the YM here because this looks like a great trade. And you say it's still doing it, so I'm going to take another one and I'm going to try and build into this position. In a lot of occasions, it'll turn around. But this Nasdaq can lead this position for a long, long time. So the fact that one's a way down low and one's a way up high isn't itself enough justification. Look, these two trades, we've got the exact opposite trades, and yet we've got two trades that are losing money. A great example of what I'm talking about. Just because one's leading the other in terms of the way it's setting up and the way it's structuring doesn't mean that you've got a great trade. That is not what makes a spread. Just because it widens is not a great spread trade, because it could, as you well know, it can widen and it can widen and it can widen and it can widen and it can widen. A great spread is based around a story, a narrative of what's happening that causes the spread to happen, and then looking for the signals that suggest that the spread is no longer going to happen. And then you can start recognizing perhaps the opportunity to step into a very wide spread. Just because it's wide is never going to be a reason. And there's an awful lot of retail guys out there that's what they'll do. They'll try and teach you that it's just about the spread widening. The spread is widening, so it's time for us to do business here. The idea is that it's going to be a mean regression or a mean reversion or a move back to a POC or a linear regression type scenario. There's a load of bollocks. It's an absolute load of bollocks. It doesn't happen. Obviously, the only thing that you can look at in that does happen with any regularity, with 100% certainty, is going to be what? It's going to be something like the Prem, because that has to happen. It's the same product. You're trading two different products, and to think that this spread has to do certain things. The Nasdaq long can lead the YM for days, weeks, potentially months. And if you keep adding into it over that period, you're going to get annihilated. Now, obviously, what I'm starting to see is I'm starting to actually see that setting up as a possible trade now, where you would be looking to try and look at that and say, well, I should be selling YM and buying NASDAQ. Well, selling that looks like the right trade, and you'll see that this will start making some money sometime soon. Now, obviously, it already widened quite significantly. So if I'd started the process instead of it just being wide, if I'd started the process when it was setting up as a possible process trade, I could already be substantially in profits during that period, because I would have been able to make some nice cash out of that trade, couldn't I? But obviously, the point is that you can see that it's quite clearly not just about the fact it's widening. You still have to time. And, and I was trying to show you a losing trade here in case you're looking at this saying, oh, that wasn't very successful. I was purposely trying to show you the fact that you can't just trade this based on movement. A lot of the times you'll get lucky and it'll look great and you'll see what's happening. The trade I did this morning had a reason. The trade I did on the gold silver had a reason. This had no reason except for the fact it was widening. I was trying to illustrate that it's not just about putting a trade on. It's not just about putting a deal on this screen. It's got to be reasonable. It's got to have a reason behind it. Now, that reason's kind of gone off just now. So obviously, you're just going to have to put up with the fact that you're in a duff trade on this one. You cannot start thinking that if one's going up against the other, you can start selling one and buying the other, and you're going to consistently make money. I'm sorry to burst your bubble on that one. That's not how it works. If only it was, it would be very, very easy, wouldn't it? But what I was trying to show you guys is that there is a relative value when you do set up a trade. When a trade is setting up that you want to take advantage of, the depth of market allows you to line up the current price, the current bid-offer spreads, and then execute. And you can watch that bid-offer spread evolving into a proper trade, which obviously at the present moment we're not seeing because, as I said, it's not actually a trade that I would have taken. It was setting up a trade that I would have taken, and it would have made a small amount. It would actually still be in profit just now when I took it. But it is what it is. It is what it is. At the moment, I'm waiting to see if it actually goes out so that we can see if we can actually get this trade into a far better position. So I'll just close it off. It doesn't make any difference, does it? So when you're looking at this, guys, don't fall into the mistake that if one of these starts declining and one starts rising, that you can just simply sell the high one and buy the low one and you're guaranteed to make money. That isn't how spread trading works. It's the retail's view of spread trading. Oh, it's dead easy then if I just do that. Yeah, sometimes you'll get lucky on it and sometimes you'll get busted on it, but it's not going to give you a consistent net profit because leaders and laggards, of course. If you're selling a leader on the way up, because obviously the leader's always going to be higher, that's exactly what's happening, right? You're selling a leader. Well, we already know that that's not a good proposition. That leader can go on to lead the market higher for a long, long time. So all these idiots that do these types of courses where they try and tell you it's just about the depth of market are just idiots. They're going to lose your account almost instantly you start trying to do it because these things can widen a long, long time. It's got to have a reason, guys. I'll be watching this. If it sets up, obviously, I'll start looking at putting one in there. If we see any YM NASDAQ one setting up, we'll try and fire it in so we can see how it performs. And you can see how ultimately the trade evolves during that period, yeah. But we'll give you a shout if it shows. If we see any setting up, we'll start putting it in, and we'll take a couple of screenshots. We'll bring over the depth of market, and we'll obviously look at it as it goes. So welcome in, guys. This morning it's been dominated by PMIs, flash manufacturing services. We've got Eurozone French, we've got the Germans, we've got the Brits, we've got the EU manufacturing and services. We've also had the Japanese, we've had the Australians this morning. So we've had a lot of numbers. Coming up in just 1 minute, we've got the Canadian retail sales. Canadian numbers coming in a little bit weaker than expected there, guys. Canadian numbers a little bit weaker than expected. Who's still making money on that short bond? Who took the short bond with me, by the way? I did ask earlier. Did anybody take it?